Hello, everybody. My name's Bob Klefsis. I want to welcome you to the All-Star Financial Third Quarter 2017 webinar. The title of our webinar this quarter is "The Rally Continues in the Third Quarter? Big question mark, how long can it continue?" When we look at our previous webinars, we've always just kind of had me in front of the camera. We're going to change a little bit after I do Bob's Corner. I'm going to throw it to Alexander Shelebu, our CFA and portfolio manager, and then he'll throw it to Brian, our CFO and COO. So Brian Sensky. So welcome. Great to have you with us as a client, current client, as a potential client. What we talk about in Bob's Corner is just kind of something that's unique. Are we making history right now? 10 years ago today, or the 9th, I believe, October 9th, U.S. equities topped. We saw a 55 to 60% tumble because of the mortgage meltdown, which is now defined as the Great Recession. It took the equity markets 5.5 years, the S&P index, 5.5 years to make a new high. From the bottom, it's 260+% return growth, which is fantastic. But interestingly, we have three sectors that have not gotten back to their original valuations: financials, telecom, and energy. So very interesting there. But again, just to let you know, we ask this question all the time. Will there be another record meltdown? We believe the answer is no. We believe that there's a correction is definitely in the making. We've been 9 years on a bull market run, which is kind of scary, but we took chips off the table. We've really we're ready for it. We believe we've taken chips off the table in the U.S. market. We bought international, had a great international performance so far this quarter or year. In fact, 2-to-1 to the domestic market. And we've had more international in my career than domestic for the first time, which shows you that our value approach is working. It's just really the patience that we need to do. I'm going to throw it over to our portfolio manager, Alexander Shelebu, and he's going to follow up and continue on with our market overview.
Hi, I'm Alexander Shelebu, portfolio manager at All-Star Financial, and I will briefly review the year's performance across some asset classes. Well, the rally continued in the third quarter, and we are now in our 9th year of this bull market. Another year and a half, and we are at the longest in history. The broad U.S. equity market returned 4.5% in the third quarter and is up almost 14% year to date. Large cap stocks outperformed smaller stocks, but we did see some small cap stock rally at the end of the quarter and narrow the gap between large and small caps. We think this was partly due to investors' anticipation of the tax reforms that would potentially benefit small companies more than large companies. Most asset classes are on track to provide above historical averages for 2017, and valuations are stretched, especially in the U.S. We also see volatility continuing to be historically very low, and I'm personally amazed that nothing seems to worry investors. And it's my job to always think about risk, and like many of our clients, we keep wondering when and how will it end. History shows different reasons behind the end of a bull market run, such as Fed tightening too much and too fast, or the market cycle moving into recession. Currently, we don't think there is a high risk of recession, and we certainly keep a close eye on potential risk of interest rates moving higher. The equity rally is broad-based, and performance outside the U.S. has been even stronger than domestically. The broad non-U.S. market returned about 6% for the quarter and is up over 21% year to date. Among the reasons this great performance is stronger synchronization of global economic growth, which is supporting equity markets. The big story of the year, though, is the rally in the emerging markets. After years of underperformance, emerging markets are now the leading performer and returned close to 8% in the third quarter and is up amazing 28% year to date. At All-Star Financial, we're patient investors and we continuously look for value-driven opportunities. Our call to overweight emerging market was early, but our process guided us, and there was compelling relative value in the emerging market, and our clients have been rewarded for this early move. Looking ahead, we still see good relative value in both international and emerging markets. So what can stop this bull? Well, there are still several reasons for investors not to get complacent, but to be cognizant of the risk that quickly could undermine global growth. These risks include domestic and international geopolitical risks, such as increased tension with North Korea, the uncertainty of US implementation of reforms, the outcome of Brexit, and the populist movement in Europe. Let's switch over to fixed income. Rates around the world continues to be historically very low. But with improving global economic growth, the rates are nudging a little bit higher. And in the US, we saw the Federal Open Market Committee announce that it will start shrinking its huge balance sheet. And the market is expecting a third rate hike before year-end. Bond yields fluctuated during the quarter, and overall the yield curve flattened as investors are worried about higher interest rates and prefer the shorter end of the curve. The broad US fixed market returned about 0.85% in the third quarter and is up 3.1% year to date. With low expectation of recession, investors continue to support high yield, which was the best performing sector with 2% return for the quarter and 7% year to date. The global fixed income markets returned a little bit more than the US, about 1.8% in the third quarter and 6.3% year to date. As with equities, fixed income in the emerging markets led the way with a return of 2.6% for the quarter and 9% year to date. Our fixed income portfolios are globally diversified and benefited from exposure to both emerging market and US high yield. To sum up, we are in the second longest bull market in history, and as we've been pointing out earlier, valuations are in the US equity market stretched, and although the non-US equity markets have provided strong yearly returns, relative valuation still favors international and emerging markets. Yields continue to be low globally, and investors are expecting the Fed to increase interest rates, which can be a headwind for fixed income markets. Therefore, we think here that it's more important than ever to construct diversified portfolios that really focus on areas where relative valuation gives patient investors opportunities to be adequately rewarded for the risk that they're bearing. Thank you very much.
Hi, I'm Brian Sensky. I'm the Chief Operating Officer and Senior Wealth Advisor at All-Star Financial. I'm excited about taking this opportunity to explain to you a little bit more about our theme using international equities to add value in your portfolios. As you can see by this chart, since the bottom of the market in March of 2009, US equities have increased 272% since the bottom. Over that same time period, international equities have only increased 117%. At the end of a cycle, which we're close to, typically what happens is something we call mean reversion, where these two asset classes come to the mean. If that does happen, international equities have the opportunity to outperform significantly here at the end of the cycle, and that is why we have an overallocation in our portfolios. The other thing I'm looking forward to speaking with you about is cybersecurity. Since the data breach at Equifax in September, there's been a lot of attention given to this topic, and we wanted to share 4 ideas that can help you protect yourself. One is multi-point authentication. This is an option for you at a lot of banks, at Wells Fargo, US Bank, BMO, Citi. A lot of banks are offering this process where when you log into the account, it also sends a code to your cell phone that's required to get in. This ensures that a thief or a hacker can't get into your account unless they have your cell phone in hand. The second opportunity is managing passwords in a better way. A lot of us like to use the same username and password across multiple accounts. This is not a good idea. Once a hacker has one username and password, they'll try to use it at as many websites as possible. So using different ones at each, especially in financial accounts, is a best practice. Credit monitoring services is a good opportunity as well. Since the Equifax data breach, they are offering their own for free for a year. The real benefit to this is the insurance. If you sign up for their service, you get $1 million of identity theft insurance for free, and that's really the benefit in our mind. And then lastly is freezing your credit. This is really the most detailed way and the most conservative thing you can do to protect yourself. There is some effort required and a little bit of fee. You need to reach out to each of the 4 credit bureaus and tell them you'd like to freeze your credit, and there's a $5 fee at some of them. And then the next time you apply for some sort of credit, you need to contact them to unfreeze it. I hope you've gained a little bit of knowledge from these 2 topics, and I look forward to seeing you soon. Now we'll throw it back to Bob to wrap us up.
Thanks, Brian. I'd like to go through our summary on our newsletter for the webinar. Talked about it. Strong corporate earnings along with low unemployment and low inflation have really driven the market thus far. Good tailwinds could pass us on to fourth quarter and into 2018, but there's a big historic length in the bull market, and only the third longest bull market in the history since 1900. So we need to be concerned about there. Are there any external events that we have as concerns? Definitely. North Korea, a missile launch would do it, bring the market to a downturn. Washington stalemate would believe to do that also. We feel that the infrastructure spending, healthcare, and tax reform is built into the market to a point where I think it would come down. And then Fed actions. They really want to pay off some of the debt that they incurred over the quantitative easing part of our economics the last 7 years, along with raising interest rates at the same time. We're just fearful that all good things kind of come to an end at that point. So hopefully they don't do that. The international markets for sure are still cheap. We believe that their process of easing, they're a little bit behind us quantitative wise. So they've got our growth that we have in front of them versus behind them. So we still think that international markets are really a good buy. And we really want to continue in an environment that we're in today about value. Again, value wins along with diversification. So want to make sure that you understand that now, even more importantly than ever before, in my 30 years of money management, staying disciplined with value and making sure that you're diversified to reduce risk is really key. I want to finish up by talking about Just for Fun. We have a restaurant, Lucia's in Uptown, that's just fantastic. It's got great reviews. Our recipe for the quarter is from Ashley, and it's a crock pot taco soup, which is fantastic. We tried it out last week. And then the quote of the quarter, I always like to quote somebody that gives us motivation. Success is really all about persistence and doing the right thing for the long term. And we think that we have that patience that brings that ability to be successful for you in the investment side of the world. We also want to mention that we've got a lot of referrals over the last year. Bring those on. Again, continue to do that. It reduces your fee. Our average fee when we put this together was about 1%. Now it's less than 80 basis points. So a lot of our clients are taking advantage of that fee program to reduce your rates if you bring assets in from referrals. And we want to make sure that you guys go to our Facebook, LinkedIn, and YouTube. Follow us. Get all your friends to follow us. Again, our goal would be to double every quarter our Facebook and LinkedIn and YouTube transactions and hits. So want to say thank you. This is the All-Star Financial information that you need to have, telephone numbers and names of our teammates. But again, thank you very much for entrusting All-Star Financial and as your wealth manager. And we will look forward to hearing from you in a phone call as a current client or as a potential client to answer any questions that you have. Have a great day.